Decision fatigue refers to the decline in decision quality after a long session of decision-making. In financial contexts, especially investing and saving, individuals are required to make repeated, often complex choices. Research in psychology and behavioral economics shows that decision fatigue can significantly impair financial judgment, leading to suboptimal investment strategies and inconsistent saving habits. 2. What is decision fatigue? Decision fatigue occurs when mental resources are depleted due to continuous decision-making. Key characteristics: reduced self-control, increased reliance on shortcuts or habits, avoidance of complex decisions, preference for easier or default options. This mental state directly affects financial behavior. 3. Why finance is vulnerable to decision fatigue. Financial decisions often involve uncertainty and risk, complex information, long-term consequences, frequent choices, spending, saving, investing. These factors increase cognitive load, making individuals more susceptible to fatigue. 4. Effects on saving behavior. Reduced self-control. Decision fatigue weakens discipline, leading to impulsive spending instead of saving, failure to follow budgets, inconsistency in saving habits, preference for immediate rewards. Fatigued individuals are more likely to choose short-term gratification over long-term benefits. 5. Effects on investment behavior. Simplified decision-making. Investors may rely on shortcuts, such as following trends or others, herd behavior, choosing familiar assets without analysis, avoidance and inaction. Decision fatigue can lead to delaying investment decisions, sticking with suboptimal portfolios, avoiding necessary adjustments, increased risk of errors. Fatigue reduces analytical thinking, increasing the likelihood of poor risk assessment, emotional reactions to market changes. 6. Psychological mechanisms. Ego depletion. Mental energy used for decisions becomes limited, reducing the ability to make rational choices. Heuristic dependence. Individuals rely more on simple rules or biases when mentally tired. Emotional influence. Fatigue increases emotional reactions, such as fear or impulsivity. Default bias. People tend to stick with preset options when decision-making becomes difficult. 7. Long-term consequences. Lower savings accumulation, inconsistent investment strategies, missed financial opportunities, increased financial stress. Over time, these effects can significantly impact financial well-being. 8. Strategies to reduce decision fatigue. Automate financial decisions. Automatic savings transfers. Recurring investments. This reduces the number of daily financial decisions. Simplify choices. Limit the number of investment options. Use clear financial rules or frameworks. Schedule important decisions. Make financial decisions when mental energy is highest, e.g. mornings. Use predefined rules. Examples: save a fixed percentage of income. Rebalance investments periodically. Take breaks and manage energy. Rest and recovery improve decision quality. 9. Practical applications. Setting up automatic savings plans. Using index funds or simple investment strategies. Reviewing finances at scheduled intervals instead of constantly. Avoiding major financial decisions when mentally exhausted. 10. Conclusion. Decision fatigue has a significant impact on both saving and investment behavior. It reduces self-control, increases reliance on shortcuts, and leads to avoidance or poor financial decisions. By simplifying choices, automating processes, and managing mental energy, individuals can minimize the negative effects of decision fatigue and maintain consistent, rational, and long-term oriented financial behavior, ultimately improving financial outcomes.